All right, let's just dive right into this explainer and decode a pretty fascinating secret. We're going to look at exactly how the ultra wealthy use real estate, not just as a nice place to live, but as a strategic, absolute superpower to build and preserve their wealth over the long haul.
To really wrap our heads around the sheer scale of what we're talking about here, consider this. $6 trillion. That is equivalent to roughly 10% of global GDP, and it's set to be inherited worldwide over the coming years. We are quite literally watching a massive generational wealth transfer unfold. And here's the thing. It isn't just about passing down cash. It is all about passing down solid, tangible assets. Real estate is sitting right at the absolute center of this massive economic transition.
So we're going to break down the 6 pillars of the Millionaire Real Estate Playbook. Assets over just homes, the power of patience, innovative income and financing, diversification, the luxury asset class, and finally, lessons for every investor. This is all pulled directly from the latest market intelligence from places like Sotheby's, Manulife, and JP Morgan.
Okay, pillar number 1, assets over just homes.
You know, when the ultra-wealthy buy property, like say a stunning clifftop place in New Zealand, they aren't just buying it for the killer view. Sure, the lifestyle appeal is great, but they are strategically acquiring tangible assets that act as a massive hedge against inflation. They're specifically targeting locations with growing populations, booming infrastructure, and high rental demand. It's a complete shift in mindset from just owning a home to securing a real endurance test for their capital. It really is a totally different way to look at property. While your average buyer is, sweating over short-term market swings, or maybe just hyper-focused on their primary residence, high net worth investors are out there building financial fortresses. JP Morgan points out that in an era of sticky inflation, meaning a period where high prices just stubbornly refuse to drop back down, anchoring your money in real physical assets is an absolutely crucial defense strategy.
Which leads us perfectly into our second pillar, the power of patience.
Patience is really what separates the pros from everyone else. Institutional investors, like Manulife, are looking at massive secular themes, which is basically just finance speak for fundamental, decades-long shifts in how the world actually works. We're talking about things like aging populations and the global push toward green energy. You literally cannot capture the value of these massive shifts overnight, right? You have to hold real assets over decades and just let market appreciation do the heavy lifting for you.
And the data completely backs this up. Get this, Sotheby's recent market intelligence shows that only 10%, literally just 10%, of global luxury property purchases are primarily driven by quick capital growth or immediate rental income. That proves the endgame here isn't a quick flip. It's all about multi-generational stability. It's about building a legacy and transferring wealth by acquiring properties that will literally outlast them.
Moving right along to pillar number 3, innovative income and financing. Technology is totally rewriting the rulebook here. We aren't just talking about your standard 30-year mortgage anymore. Sure, real estate already gives you multiple income streams, like rental yield and long-term appreciation, but the financing itself is evolving super fast. The use of cryptocurrency as collateral for property loans is exploding. Estimates suggest Bitcoin-backed loans are going to skyrocket to over $45 billion by the year 2030. It's a huge shift, letting the wealthy unlock cash without ever having to sell off their crypto. Dubai is a perfect example of this in action. Over there, 30% of ultra-high net worth individuals now holds crypto assets, and it's heavily impacting their real estate market. Sellers in global hubs, Dubai, California, New York, they're increasingly saying, yeah, we'll take crypto. This lets tech-savvy wealth creators seamlessly merge their digital assets with tangible real estate, building these really innovative dual-growth income streams while keeping their core portfolios completely intact. All right, let's get into pillar 4, diversification, because successful investors rarely keep all their money in one place.
The data from Sotheby's reveals a pretty fascinating strategy. Nearly a third, 28% of all luxury purchases globally, are actually second homes. And in wealth hotspots like Florida, that number shoots all the way up to 54%. So these individuals aren't just buying one mega mansion and calling it a day. They are actively curating a global portfolio of properties to balance out their lifestyle, their business, and, most importantly, their risk.
Spreading this capital out globally is absolutely vital right now. JP Morgan is basically telling people to diversify way beyond traditional stocks and bonds to handle current market pressures. On top of that, Manulife points out that de-globalization, the trend of countries pulling their supply chains back within their own borders, makes regional resilience critical. And since wealthy buyers aren't really tied down by geography, they protect their portfolios from local geopolitical drama by spreading their assets all over the world.
That brings us to Pillar 5, the luxury asset class.
Premium real estate kind of plays by its own rules. Think breathtaking resort-style developments in Dubai. They operate almost completely independently of everyday affordability issues. Why? Well, they cater to cash-rich buyers who are hunting for extreme stability, hotel-style amenities, and absolute privacy. It's a highly insulated asset class that consistently outperforms the broader housing market, mostly because there's so much global wealth chasing a very, very limited supply.
To put this into perspective, just look at New York City. A recent contract for a penthouse in the West Village went for $87.5 million. Wild, right? But it just proves that even with global economic uncertainty, the ultra-wealthy don't hesitate. They know for a fact that top-tier limited supply assets in prime global cities will always, always command a premium over the long run.
And finally, Pillar 6, lessons for every investor.
Look, we might not all be dropping $87 million on a Manhattan penthouse tomorrow, but anyone can actually use this playbook. Step 1, anchor your own portfolio in quality, tangible assets that protect against inflation. Step 2, adopt that patient, multi-generational timeline. Seriously, ignore the daily market noise and let compounding do its thing. And step 3, diversify. Look beyond your domestic borders and traditional asset classes to build some real financial resilience. So as we wrap up this explainer, I want to leave you with a question. Is your current investment strategy just chasing the next quick win? Or are you truly building a legacy that's going to outlast you? The Millionaire Playbook proves that true wealth isn't just about what you make today. It's about the assets you preserve and grow for tomorrow. Keep building that legacy, and I will catch you on the next one.